to the cloud. All right, and start video. Can you see my video now? The lights went up. The lights went up here in the office. So, all right, Lily, we're going to go ahead and get started. So this is the first session is an introduction to the world of insurance. And Dr. Latanya, if you could just keep an eye on the waiting room, make sure nobody else joins. Thank you. It's an introduction to the world of insurance. Okay, so in the United States, we refer to the world of insurance. We refer to the whole insurance industry as our world. Okay, so when you hear it referred to as the world of insurance, we're talking about in the United States, right? So in the United States, in the world of insurance, there's three major players. We're going to learn and discuss and talk about those three major players that make up an insurance contract transaction and what the roles of those players are. We're going to talk about 5 significant actions in the development of an insurance offer. So 5 things that take place in the course of an insurance contract coming to pass. And then 4 elements of a legal contract. 4 things that each contract, each insurance policy absolutely must have in order for it to be upheld in a court of law. And then some other key terms and essential knowledge. All right, so if you look at the background, you see this diagram here, the United States of America, and you see this arrow here. This arrow is pointing outside. So it started on the inside of the United States, it's pointing outside of the United States. If the United States is our world, then any insurance company whose principal office or home is domiciled, which means just means located outside of the United States, they're considered an alien insurer. Okay, we're human beings, we occupy Earth. Any being that came from another planet to this planet of Earth, we would consider them an alien, right? So with respect to that, the same goes for insurance companies who are domiciled or have their home location outside of the United States. They're called alien insurers. Okay. Now, an insurance company that has its home office domiciled in the United States and is providing insurance products and transactions to residents in that same state in which they're incorporated, then those are domestic insurers. So if ABC Insurance Company is incorporated in Tennessee and is insuring Tennesseans, then ABC Insurance Company is a domestic insurer to the Tennesseans that they're serving. Turn this light back on. Looks a little hot. Oh, there we go. Okay. Also, conversely, if you look over here in the state of California, you see foreign insurer. Okay. You also see an arrow from California to Tennessee. So a foreign insurer is an insurer who is incorporated and its home office is domiciled in one state, but they're doing business, transacting business, insurance business with residents in another state. Okay, they are considered foreign insurers. The companies based in California servicing Tennessee residents, they are foreign insurers to the Tennessee residents. But if that same company in California is servicing its own California residents, then it's a domestic insurer to those California residents. Okay, I know this is not part of the initial base knowledge, but it is something that's important to learn. It is something that is going to be referred to on your test at least twice, so that you have an understanding of alien, foreign, and domestic. And we just introduced that to you in the very beginning as the first slide to give you a little bit of confidence that, hey, I'm already learning some things. You know, I know something, you know, it makes sense to me. And this is kind of a reflection of how this study session goes. We try to give you analogies and clues and ways to remember things that make sense. So hopefully you remember an insurance company who's domiciled, and remember that word, Lily, domicile, because it's going to be used on the test in that exact manner. Domicile. It just means where it's located. All right. An alien insurer domiciled outside the United States, it's going to be considered an alien insurer. Domiciled in a state conducting transactions with residents of that state is a domestic insurer. Domiciled in a different state conducting transactions with someone, a resident from another state, they're a foreign insurer. All right, moving on. So here's some key things to know. Key terms, you're going to see these come up on your exam in one form or another. Adverse selection. If you think about the word adverse or adversity, something kind of negative. So adverse selection would be kind of almost like a negative selection. Okay. But also know that it is a selection. So adverse, it didn't mean negative and it gets tossed out. It meant we selected it. It was just a negative selection, meaning it wasn't, there's some risk involved in it. Ensuring of risks that are more prone to losses than the average risk. So for example, for an adverse selection, life insurance companies might charge a higher premium for a race car driver or a skydiver. And then like they might charge higher premiums for someone who lives in a high crime area, or a health insurance company might charge higher premiums for customers who smoke. So those would be considered adverse selections. It doesn't mean we won't select them. It just means there's some risk involved in that selection, okay? Beneficiary. Beneficiary is the recipient of the benefits of an insurance policy. So when someone dies, a beneficiary is selected prior to that in an insurance policy, and the person who dies gets the benefit of that policy. The death benefit is the amount that the beneficiary gets, the amount that's paid upon the death of the insured in a life insurance policy. Okay, it's called a death benefit. The insurance policy is a contract between a policy owner and an insurance company, which agrees to pay the insured or the beneficiary for the loss caused by specific events. Okay, so it could be that, it could be that the insured is covering themselves for certain instances, disabilities, or future retirement or something like that. That's where the insured themselves would get the benefit of the payout. If they were covering themselves with the life insurance policy for life and they were to die, then the beneficiary would get that payout. We'll talk more about that in just a moment. A lapse is a policy termination due to non-payment of premium. So just like many of us, I don't know, Lily, if you're like me, but I'll be honest, I have before. I've lapsed in my car insurance. So I didn't make a premium payment 1 month, and they basically said, we're not covering you because you didn't pay your premium. That's a lapse. It's the same thing for life insurance. There's no difference. Okay. Policy owner. The policy owner is the person that's entitled to exercise the rights and privileges in the policy. Okay. They own the policy. They're making all the premium payments on the policy, right? They initiated the policy. They're the ones that submitted the information on the application. So they're entitled to exercise all the rights and privileges of the policy. If you can see the slide, you see the 2 asterisks there. In the asterisks, we have a revocable beneficiary and irrevocable beneficiary. So what we mean by that is the policy owner, at the time they fill out an application, they select who the beneficiary of that policy is. Let's see. They select who the beneficiary of that policy is, right? And at the time that they make that selection, they also select whether or not that person, that beneficiary is revocable or irrevocable. Meaning, if they make that selection as a revocable beneficiary, that means at a later time, they can change who that beneficiary is. If they make them an irrevocable beneficiary, that means that they can never make changes to who that beneficiary is without legal consent from that beneficiary. Excuse me. So revocable and irrevocable. Why that would come into play if you wanted to make sure that your funds for a beneficiary were absolutely destined to go to the person you want them to go to, and there was nothing that anybody could do to make changes to it, then you make them an irrevocable beneficiary, and then not even yourself can make changes to that selection. All right, that is important to know. Revocable beneficiary, irrevocable beneficiary. Write that down. Committed to memory. It will be asked of you to remember on your test. It will be referred to on your exam. Revocable and irrevocable. Okay. Let's see. In general, insurance is a transfer of risk of loss. The cost of an insured's loss is transferred over to the insurer and spread amongst other insureds. So basically, the way insurance companies work, they pool all of the premiums from all of the clients that they have into one big pot of money. And when policy has to be paid out, they take funds from that big pot of money and they pay out policies. Okay. The more policies they have to pay out, the more those funds decrease and decrease and decrease. And that's usually what fluctuates interest rates, or not interest rates, insurance rates, increases insurance rates. Okay. It's also a reason why fraud is not a good thing, because when people commit fraud, it makes it harder for the insurance company to hold on to funds that they need to make payouts for legitimate claims. And as a result, they end up charging more for rates to make sure that they have those funds when those legitimate claims come up. All right, so if you just joined the room, welcome. I know I see a few people join. I'm gonna just take a break to acknowledge them. Ebony, welcome. Maya, I believe it's the first time I've seen you, but welcome. And Terry, welcome. Dr. Latanya, thank you for admitting them into the room. We're gonna keep going. I'm gonna keep going. All right, so this is scenario A. Again, if you just joined, we are talking about just the basic fundamentals and foundations of life insurance policies, how they're designed, how they work. So you have a stronger knowledge base of what we're actually doing here, what you're actually learning about, what are all these rules and policies and things that you're learning, how do they apply to the real thing that we're actually presenting to people as a solution. Okay, so in scenario A, you have a family here, you have a policy owner. Dad covers the lives of his children with an insurance policy and makes mom the beneficiary in the event of their death. Okay, so dad's the policy owner. He applied for the insurance policy. He's making the premium payments to the insurance company. He insured the lives of his children. So they're the insured. They're the two lives that the insurance company is insuring. In the event of their death, mom would be the beneficiary, so mom would get the payout of the death benefit. The death benefit, if you weren't here before, is the dollar amount or the face amount of an insurance policy. If and when an individual dies, the policy will pay out this amount. That's called the death benefit. In this case, mom, who is the beneficiary, would be the recipient of the death benefit. Let's go to another scenario. Scenario B. Dad covers the life of his spouse with an insurance policy and makes their children beneficiaries in the event of her death. Okay, so dad's the breadwinner. Dad applies for the insurance. Dad pays the premiums to the insurance company. He's the policy owner. He owns the policy. But the policy is covering the life of his wife. She's the insured. She's the individual that the insurance company is providing insurance coverage for, her life. In the event that she dies, their children are named beneficiaries. More than likely, they would get probably an equal 50-50 split of the death benefit. Drop a 1 in the chat just to let me know if that makes sense to you before I move on. Awesome. Thank you, Lily. Thank you, Ebony. All right, awesome. All right, we're going to keep going. Scenario C. Same family. Dad covers his own life with an insurance policy and makes his spouse the beneficiary and their children secondary beneficiaries in the event of his death. So dad is the policy owner. Dad completed the application. Dad is making the premium payments to the insurance company. And he applied for insurance on his own life. So he is, in this scenario, the policy owner and the insured. If you recall on the previous scenarios, he was just the policy owner. Okay, mom's the insured on this scenario. The children were the insured on the previous scenario. This scenario, he's covering himself. He's the policy owner and the insured. He made his wife the primary beneficiary and his children secondary beneficiaries. So if dad were to pass, dad were to die, mom would be the primary, the first beneficiary, the first recipient of the death benefit. Sorry, it got darkened. And the kids would be the secondary beneficiaries. A lot of times in this particular scenario, mom would be a 50% beneficiary and the kids each would be 25% beneficiaries. 25, 25, and 50 for 100% of the death benefit. Pretty simple, right? Kind of makes sense. We're going to go on to the next scenario. Scenario D. All right, in the event that the primary and secondary beneficiaries die prior to the insured, a select individual, estate, or trust would then receive the benefit upon death of the insured. So pause for a second, let you absorb that for a moment, let you look at the screen, and then I'll explain it. So in this case, dad's the insured. He purchased a policy on himself, okay? He made his wife the beneficiary, the primary beneficiary, and his children the secondary beneficiaries. But in this scenario, God forbid something tragic were to happen, but life happens. Mom and the children were, let's say, killed in a tragic car accident prior to dad dying. So in that case, they were the beneficiaries of the policy, but they're dead before he dies. So if he dies, then who is going to receive the death benefit of his insurance policy? That who is called the contingent beneficiary. You want to commit that to memory. That will be asked of you on your test. Contingent beneficiary, you need to know the word contingent beneficiary and who a contingent beneficiary is. A contingent beneficiary, again, is the party that's going to receive the death benefit in the event that the primary and secondary beneficiaries are not living at the time that the insured individual dies. Okay, so let me explain this further when it talks about in the event, the contingent beneficiary can be an individual, it can be an estate, or it can be a trust. So dad could say, all right, if they are no longer here when I die, then I want the contingent beneficiary to be my auntie, okay, or my uncle, or whoever, that individual. Or he could say, if they're no longer here when I die, then I want that contingent beneficiary to be my estate. My estate is all of my assets, all of my property, all of my money, everything that belongs to me when I die. And if you have your estate in order in terms of a will, what's going to be done with my estate when I leave here? Who do I want my possessions to go to? That's how that will be handled. The death benefit in that case will go to the estate, and then the estate would outline how that death benefit or how those funds in the estate are paid out. Or that person could say, I want the contingent beneficiary to be a trust. So if my wife and my children are gone, then I want that death beneficiary to be paid into a trust fund that goes to my niece or my nephew, or when they reach a certain age, or to my college alma mater, or something like that. Okay. All right, so essential knowledge, elements of a legal contract. There are 4 elements to a legal contract, and any legal contract in the United States must have 4 elements. But in terms of insurance, these specific 4 elements are required in order for a contract, which is an insurance policy is a contract. An annuity is a contract, okay? In order for any contract to be upheld in a court of law, it must meet all 4 of these elements. So let's talk about those elements. You have an offer and you have agreement, which is offer and acceptance. All right. There needs to be an offer made, and there needs to be an acceptance of that offer. Someone has to make the offer, someone has to accept the offer. We get mail order offers all the time. So you go home, you open your mailbox, and there's 3 or 4 different offers in there. Apply for this credit card, right? Send this in for this type of insurance, or send that in, call this number for this, or go to this website for that. That's an offer, right? When you fill that paperwork out and send it back in, or you go to that website and you click that button they told you to click, or you make that phone call and you say, I want to do this, then you've accepted it. So now you have offer and acceptance, and that element of agreement is met. Okay. Consideration. In order for the element of consideration to be met, you need 3 things. You need an application, you need a payment, and you need some type of promise to pay or a delivery of a product or service. So let's talk about consideration. Consideration is a word, but in this case, it's a noun, it's a thing. Okay, this element, consideration, consists of an application of some sort, a payment of some sort, and some promise to pay or deliver upon a service. So you walk into Home Depot and you say, I need somebody to come to my house to repair my refrigerator, right? They ask you for your name, your phone number, your address, right? You give it to them. You just made an application. You just applied, okay? They ask you for your credit card to make sure that they can pay for the service. You just made a payment, right? And then they give you a receipt saying, we'll be at your house in 2 days to fix your refrigerator. That's a promise to pay or a promise to deliver a product or service. If all those three things happen, the element of consideration is met. All right, competent parties. A competent party must be of legal age. They must be mentally competent to understand the contract, and they must not be under the influence of drugs or alcohol. Okay. If they're underage, they're not old enough to understand all the terminology in the contract, and probably not of legal age whatsoever to even afford to do the things as mandated in that contract. Mentally competent, sometimes if you're dealing with an elderly person or someone who suffered some type of physical or mental illness and they cannot comprehend the language in a contract in order to be able to make a solid agreement to something, then they're not considered a competent party, right? And in the court of law, if you get someone who's incompetent to sign a document so that you can take advantage of it, it's not going to be held up. All right, the other fourth element that must be met is the element of legal purpose. Purpose of the contract must be legal and not against any public policy. To ensure legal purpose of a life insurance policy, it must have both insurable interests and consent. Break that down for just a moment. It's got to be legal. You cannot insure something that's illegal, right? You can't insure a process or a product or a business or a service that is not within the outlines of the law. That's first. Secondly, to ensure legal purpose of insurance policy, it must have both insurable interest and consent. In order to attain insurable interest, you have to have that person's life has to have some value to you. Meaning you have to be a family member. You have to have a strong tie, family member, or some strong business relationship where there are some assets tied to you. Otherwise, there is no insurable interest. Okay. I can't go and get an insurance policy out on my next door neighbor. There is no insurable interest there. They're just a neighbor. They're not my family member or something like that. Okay. So the four elements of a legal contract, you will need to know these for your test: agreement, consideration, competent parties, and legal purpose. It may be asked of you in a number of different ways. So just make sure that you know that there are four elements and that's what they are. All right. So these are three players, the three major players in an insurance contract. Okay. In an insurance transaction, you're looking at the insurer, who is the insurance company. You're looking at the agent, who is you, once you become licensed and begin doing what we all love to do. You are the agent. And then you have the insured, which is they're a client before they become the insured. They're not the insured until the insurance company offers them an insurance policy and that policy is accepted. Then they become the insured. They become known as an insured. Okay. The insured, like we learned on previous slides, may or may not be the policy owner. You remember when Dad was the policy owner, but he insured the life of his wife, or insured the life of his children. So in that case, he was the policy owner, but not the insured. So here's what goes down in between the three parties. So you as the agent, you collect the application, a completed application from the client or from the insured, right? You may need to complete an agent's report that might be requested of you by the insurance company. You collect the initial premium, right? The initial premium is that initial payment for the insurance policy. And then you submit it to the insurance company for consideration. The insurance company, So the insured in that, what the client does in that scenario, basically they have to complete the application. They have to provide the premium, right? They may be asked to provide a health assessment. They may be asked to go get a physical. They may be asked for somebody to come to their home to do a health assessment on them, right? But you as the agent, you collect all of that data and you make sure that that information gets to the insurer. Now, consideration of the insured. We talked about consideration on the last slide, right? Application, payment, promise to pay, right? Application, payment, promise to pay. Three things that make up consideration. So let's go back to the next slide. The insured, application, premium is a payment. So the consideration of the insured is an application and a premium. So when the insured or the client submits an application and a premium to the insurance company, they're saying, would you consider me as one of your insured, right? So now let's zoom up top here to where the insurer is. The insured's consideration is the promise to pay for losses. So they'll review that application. They'll evaluate the level of insurable interest, which must exist at the time of the application. You want to commit that phrasing to memory. Must exist at the time of the application. Insurable interest must exist at the time of the application, meaning at the time that the client or the insured makes the application, fills out the application, the interest that they have, the life that they want to insure must exist, must be alive. They can't insure something that's going to happen. They can't insure a baby that's not here yet. They can't insure a business that they haven't set up yet, right? So you have the consideration of the insurer, which is the application and the premium, and then you have the consideration of the insurer, which is that promise to pay. That's the element of consideration, okay? You have the application, which we talked about. That's the first element of agreement. Legal purpose is an insurance contract. That's a legal purpose. Competent parties, you know, that will be evaluated by the insurance company. But you as the agent want to make sure you're doing ethical business and not operating business with someone who's not a competent party. So those are the three major players, and those are their roles in this whole transaction of producing insurance contract. We just hit you with a lot of information. Here's a little bit more, and then we're gonna take a break and then keep moving. We'll take a break, do some knowledge checks, some questions. I want you guys to be interactive. I'm gonna ask you a few questions. Keep in mind, this is for you. This is not for me, for us. This is for you. We wanna help you learn, help you grow, help you pass your tests so you can begin operating your businesses, learning, training, and getting started on a pathway to success. All right, so here are the five main functions of the transaction, how it takes place, okay? There's an application review. So once you submit that application to the insurance company is gonna review that application, all right, for the details and the accuracy of the information. They are insuring an individual's life, usually with a high dollar amount. Even if it's $150,000, $200,000, that's a lot of money in one check to give to somebody. So they want to make sure that all the information on that report or that application is accurate. All right. Misrepresentations, falsifications, incompletions, and concealments may be discovered in review. Definitely want you to write misrepresentations, falsifications, and concealments. Write those 3 words down. You will see them on your test. let's talk a little bit about what a misrepresentation is. Misrepresentation is it a lie? Maybe not. Is it intentional falsification of information? Maybe not. A so what you put on an application, every entry that you make on an application that a person makes on an insurance application is called a representation. So if it's inaccurate, then it's a misrepresentation. For example, if the application asks me to list all of the locations that I've lived in the last 7 years, and I said I lived 5 years in California and 2 years in Tennessee, but I forgot to list the 3 months during that time span when I lived in Georgia with my uncle for a minute. That might be a misrepresentation because I wasn't lying. I did live here 5 years. I did live here 2 years. Well, not the whole 2 years, but I did live in Tennessee and California. I even forgot that I lived in Georgia for 3 months. That might be considered a misrepresentation. Okay. What also might be considered a misrepresentation? An individual puts on their application that they weigh 210 pounds, but their health assessment said they weigh 212 pounds. That might be a misrepresentation. All right, a falsification. Oh, a misrepresentation. I want to say this, a misrepresentation is usually not in and of itself a reason for an insurance company to deny a policy. Okay, misrepresentations usually are not responsible for policy denials. They may ask to be corrected, they may ask to be validated, but it usually doesn't deny the policy. A falsification, on the other hand, could lead into a policy denial. A falsification is exactly how it sounds, something that was falsely stated. All right, so a falsification could be, how much money do you earn on what's your salary on your job? And you put 75,000, but you really earn 50,000. That's a falsification, which to the insurance company looks like a lie, which could, and in most circumstances, will affect or impact the insurance company's decision. All right, so a falsification is a blatant misrepresentation. All right, incompletions is just what it sounds like. If you forget to fill something out on the application, the insurance company is going to reject it and send it back to the agent, send it back to you to help, to make sure that it gets completed. A concealment is hiding something. If you guys have heard of like conceal carry in terms of gun laws, you can carry a weapon in a concealed manner, meaning you can hide it. It's on you, but nobody can see it. That's what a concealment is in insurance policy. The truth is there, but you're not telling it at all. That's a concealment. The truth exists, but you're not going to expose it at all. A concealment in almost every single case will lead to a denial if the insurance company finds out in enough time. And we'll talk about that later. There's a thing called a contestable period, where the insurance company, after 2 years, and no matter what they find out, the policy sticks. But they could cancel or deny benefits of a policy if within 2 years they find out something was concealed. Okay, so the application review, misrepresentations, falsifications, concealment, I spent a lot of time on that because you will see those on the test for certain. All right, risk calculation. After the application gets reviewed, it goes through a process of risk calculation. It's using all the information collected by the agent and provided by the applicant. The insurance company calculates and determines the level of risk it is willing to insure. Okay, so In that goes what's on the application, how much a person earns, what their health level is like, what their, what level of insurance they're asking for. All that goes into play for the insurance company. So risk calculation is a term you need to be familiar with. You will see that again in wording and phrasing. So you just understand what it is. They're calculating, using all the information available to them, what level of risk they want to insure. All right, then it goes through an underwriting process. Once the risk is kind of calculated, then the underwriting department, they'll use additional information, including consumer reports and MIB records. I want you to write down MIB records. You need to commit this to memory. It will be on your test. MIB records stands for Medical Information Bureau. It doesn't stand for Men in Black. All right. So the underwriting department will use additional information, including consumer reports and MIB records, to approve or deny an applicant and assign the risk classification or the rates. So MIB, the Medical Information Bureau, if the IRS is a database in a warehouse on everything related to a person's taxes, then MIB is a database in a warehouse on everything related to a person's health records. Okay. So any health organization, doctors, hospitals, or whatever around the country can tap into this database. Insurance companies can tap into this database and get information, medical information, past history on an individual, right? So MIB, Medical Information Bureau, you need to know that. It will be asked of you on the test. Another thing that will be asked of you on a test, or might be asked of you on a test, is that a medical MIB record alone by itself cannot legally result in an application denial. So an insurance company cannot use only the information on an MIB report to deny someone. So if that MIB, no matter what that report says, that MIB report says this person has, I don't know, HIV or stage 4 cancer or something like that, some critical chronic illness maybe, that the insurance company might not want to insure. They cannot use the MIB report as the sole source of information for making that decision. They need to have other information to make the denial, because what we're commissioned to do as insurance companies is try to provide options for people. So that can't be denial. We have to provide another option for them. Or if we don't have options that fit their financial situation, and we can determine that because of the consumer reports that we pulled up, then we can deny. Okay, so all you need to know is the MIB report can't be the only reason for a denial, can't be used solely for denial. All right, premium collection. We don't mean premium collection as in, a collection of towels or some clothing line. We're talking about collecting the actual premium, which is collecting the payment, right? So in most cases, the initial policy premium is collected by the agent, you, and submitted to the insurance company for consideration, along with the completed application, thereby making this collection date the effective date of the contract if the application was approved. We'll talk more about that in a moment when we get back from break, so you understand what I just said about the collection date and that payment. But the premium collection is collecting the payment. And then there's a policy delivery, which is basically delivering the policy, making sure that the applicant, the client, has the insurance policy in their hands or in their email, or however the policy is delivered. Typically it's by mail or by hand. So those are the 5 steps: application review, risk calculation, goes to the underwriting department, a premium and the application is collected, the decision is made, and the policy is delivered. All right, we have come to a breaking point. I do know that one of us on here, I think Lily may have to leave early. So that this would be a time, Lily, that if you have questions or anyone else in the chat, if you have questions, let's take a moment to ask those questions about anything we've reviewed to this point. If you have questions, go ahead and either come off mute and ask them. That's probably the quickest way to do it, but feel free to type it in the chat. All right, Lily, thank you. So what I want, real quick, I'm going to ask a couple quick questions before you go, Lily. And before we go to break, the break is going to be short. It's going to be 5 minutes, just enough to use a restroom, go grab something to drink or something and come back. And then we'll continue on for the second 30 minutes of the session. But a quick knowledge check. I want to see if you guys are writing some things down. I ask you to write down because you are going to need to know them for the test. So, question 1, if you're here studying, I want you to type in the chat, what does MIB stand for? What does MIB stand for? Type it in the chat. That's it. Very good. Medical Information Bureau. Medical Information Bureau. If you're in the chat, guys, if you're in the, in the room and you haven't gotten your license yet, I'm asking you to engage too, because we're doing this for you. We want you to be successful. We want you to pass your test. It's not about whether or not you know the answer. This is about you learning so you can be successful. All right, another question. Another question. In the event that the primary and secondary beneficiary die before the insured of a policy dies, who would receive the death benefit? In the event that a primary and secondary beneficiary die before the insured, meaning there are no secondary or primary beneficiaries anymore, who then receives the death benefit of a policy when the insured dies? Very good, Lily. Contingent beneficiary. Awesome. Very good. And last question before you go. If a person forgets or fails to make their premium payment, the company will terminate or withhold services from their policy. That period is called what? Starts with an L. Very good. Awesome. All right, Lily, very good. So, there's some things you have fundamentally already committed to memory. You were able to answer them quickly. I hope that you built some confidence in what you learned today. We want to get you scheduled for your exam as soon as possible and get you passed so we can get you going. So I know you said you had to go. So thank you for being with us this evening. I hope you have a safe night. And if you're back with us on Wednesday, we will see you then. Sorry, I'm talking. I should be talking to the camera, but thank you, Lily. All right, we'll see you Wednesday. Have a great evening. Let's see, who else is still in here? Also, KD, Alderson, Maya, thank you for being here. I think it's your first time that I've seen you guys' names in here, so welcome. We're gonna take a break, 5 minutes. It is now 6:58. We're going to come back at 7:03 and get started, okay? We'll be right back. That you got time to get a drink, use a bathroom, whatever. We'll be right back.
Of working for a boss, a company, or a wage that doesn't excite you? How will you break free from the limitations of being someone's employee to the lifestyle of an entrepreneur?
All right, can you guys hear me? If you can hear me, put a 1 in the chat. I'm looking to see if I am being heard. I'm not sure if I am or not.
Yes.
Awesome. Okay. Thank you, Tasha. And Maya and KD, if you are in the room, can you put a 1 in chat just to make sure that you guys are active and ready to roll?
Oh yeah, I'm ready.
Okay, awesome. All right, we'll go ahead and get started then. All right, so that last video was really just talking about WFG and what we do here. So we're looking forward to getting you guys started and getting going. We are a group of families and individuals who are looking to help other families and other individuals. So you're made a wise decision to start making some changes in your life and helping other people make changes in their lives. Nobody on earth will ever not need what we offer. They might not always take it, but nobody on earth will never not need it. So all teams within Pinnacle WFG family, we believe in what we call the 5 F's. They are family, finances, fitness, faith, and fun. And actually faith is first. It's faith, family, finances, fitness, and fun. Okay. We welcome you to Excellence Leadership Development, and we're committed to your success. All right. We're gonna go ahead and get started now. So more information, some essential knowledge, just some nuggets to understand. Again, we talked about this on the last slide right before we left, and I hammered the point home about the MIB for a reason, because I know for a fact you're going to see it on the test. You probably have already committed to memory that it stands for Medical Information Bureau, and that first one, insurers cannot refuse coverage solely on the basis of adverse information on an MIB report. Okay. Also, the higher the risk, the higher the premium. That's just a general concept to understand. All right. If a person is closer to death, meaning they're age 65, the average mortality rate might be 75, right? That person, his premiums are probably going to be higher than somebody who's 25 because they have a lot more years to live. There's a lot less risk involved in them dying sooner than later than someone who's 65. So the insurance company would likely charge a lower premium for someone who's younger, higher premium for someone who's older, all right? Or if I'm someone who races cars for a living, it's gonna be more costly to insure my life than someone, a soccer mom who just drives back and forth to work and drive the kids to soccer practice 2 or 3 times a week, okay? So the higher the risk, the higher the premium. If you understand that, that'll help you understand how insurance transactions work, how decisions are made. And so when some questions are asked of you on the test, they won't be able to spin you around with their wording because you understand what's actually going on here. All right, the policy owner must have insurable interest in the life of the insured. That's also a concept that you're going to be expected to learn on the exam. We're telling it to you right now. If you understand that insurable interest must exist, the person who owns the policy, who applies for the insurance, who is making the payments on it, they must have an interest in the individual that their policy is insuring, like family, right? Husband, wife, husband, wife, child, insurable interest. Or it could be a business they're insuring, or an asset they're insuring. But I can't go insure my neighbor's house and expect to get a benefit off of it if it burns, right? That's not my property. All right, an insurance application is the key source that underwriters use for information about the applicant. That statement will be asked of you on the exam. In some way, shape, or form, you need to know that the key source for that the underwriters use for insurance information is the application. So the more accurate that application is, the more thorough, the more detailed that application is, the greater the chance of a person getting approved for that insurance policy. All right, so here are some roles and responsibilities for you as an agent. Once you become licensed, you become an agent. Here are roles and responsibilities of an agent. All right, and we're talking about those roles and responsibilities, but in this slide, you're learning things that are going to be on the exam in relation to what you would have to do as an agent. All right, you have to ensure that a completed and signed application is presented, right? If it's not signed, it's going to be sent back to you. If it's not complete, it's going to be sent back to you. That might even be referenced on your exam. What happens with an unsigned application? Maybe not asked in that exact way, but in some fashion. All right. You have to collect the premium from the applicant. Sometimes it's a physical premium payment, like cash or a check, money order, I don't know. Sometimes it's you are providing the access to the platform for them to provide a credit card payment or something like that. But you collect the premium from the applicant. All right. You also produce the agent's report and or collect a statement of health on behalf of the insurer. The insurance company might ask you for more details and information on what you know about this applicant. They're going to ask you to put that in the agent's report. Okay. They might also ask you to have the applicant submit a health assessment. All right, some information from health records. They can go to the MIB and find it, but they're going to try to seek that information first from the applicant. Ultimately, they're trying to find out how honest and forthright the applicant is. All right. You're going to act as a field underwriter on behalf of the insurer. So we talked about the underwriting department and what they do. You're that person in the field. You're collecting the data. You're the person making the general assessments. You're the person who helping to determine what's the best route and solution for the individual or the family sitting in front of you based on their needs. Okay. You're the field underwriter. You're going to deliver the policy results or policy documents to the client. So if the insurance company says they're denied, then you're the person delivering that information or that news to the applicant, right? If the insurance company says they're approved, you're the person delivering that information. You may also be the individual delivering the policy summary. In most cases, there'll be an email transmission of policy information and physical mailed copies of the policy to the policyholder owner. You're going to act with fiduciary responsibility when dealing with client premiums. Fiduciary responsibility means being responsible for people's funds, being responsible with other people's money. Okay, a bank is a fiduciary. Okay, a fiduciary responsibility is both something that occurs, and a fiduciary is also actually a thing, a noun. Long lights. Okay, so a bank's financial institutions, they're considered fiduciaries. They have a responsibility to ensure that they do right with people's money. That's a fiduciary responsibility. Okay. If you think when you go to a bank, right, and you see it says FDIC on a little plaque in the bank, so fiduciary has all those letters in there. All right. And if FDIC helps to ensure that these banks are doing right with people's money, right? So maybe that'll give you a hint or a clue as to understanding fiduciary. All right, so you're going to act with responsibility when dealing with client premiums. You do not want to take a client's premium, and they might be asked of you in this way on a test. You don't want to take a client's premium and deposit that money into your account and then making a payment to the insurance company from your account. That's not acting with fiduciary responsibility with someone's premiums. okay? The way you act with fiduciary responsibility with someone's premiums is make sure that you immediately submit that client's premiums to the insurance company. All right, and then you're gonna uphold all state and federal insurance producer laws. There are laws that the federal government mandates and laws that the state mandates, okay? In addition to these roles and responsibility, and this statement has nothing to do with your exam, this has everything to do with you being members of our teams and us helping you to develop into the leader you want to become, into the business professional you want to become. In addition to these roles and responsibilities of an agent, personal development is not only expected, but it is the primary key to your success, okay? This is a business that requires you to earn people's trust. So you have to develop yourself to be able to do that. You have to be able to communicate. You have to be able to listen. You have to be able to meet people's needs, understand, visualize. You also have to be able to help people see a vision for themselves, okay? All right, so we help you develop in those areas as well. Okay, so this slide has a lot to do with some of the legalities around insurance policies in our industry. So STOLI, stranger originated life insurance. It is what it sounds like. Stranger originated life insurance. A stranger tried to originate life insurance on somebody they don't know. That's what STOLI is. That's what stranger originated life insurance is. It's illegal. Well, it's not illegal, but it is definitely not something that is accepted in the insurance industry. So they don't do it as much as they possibly can. It violates the principle of insurable interest. If I'm a stranger, like I told you before, I can't go and get a life insurance policy out of my next door neighbor, right? I'm trying to originate a policy on a stranger. Can't do that. There is no insurable interest there. So you will see that on the test. You will see it referred to as STOLI maybe. So I try to highlight it a little bit to help you understand it, right? Buying a new policy on a stranger, you're gonna hear it referred to on a test somewhere in relation to that or in relation to not having insurable interest to do so. All right, a life settlement may also be referred to on your exam, or a question may be asked of you on your exam. A life settlement is not an illegal act, okay? It's a lawful transaction that does not constitute STOLI, which is a stranger originated life insurance. A life settlement is selling an existing life insurance policy. So here's an example of how a life settlement works. It's a lawful transaction by which the owner of an insurance policy takes an advancement on the death benefit of the policy from a third party. And in exchange for the cash advancement, the third party is named the new and irrevocable beneficiary of the policy. And they'll receive the full death benefit upon the death of the insured. In other words, I get a policy on myself. It's $1 million insurance policy. I'm 85. I'm still not dead yet. I got some more years to live and I want to do something with some of that money. So I'm going to sell that policy to someone or, someone for $500,000 so I can spend the rest of my 2, 3, 4, 5, however many years I have left on this earth using that money right now. Okay. That I make that person that I sell that policy to for $500,000, I get to buy $100,000. I make them the irrevocable beneficiary. When I die, they get the $1 million. So they got paid back the $500,000 they gave me plus another $500,000. Okay, that's not illegal to do. All right. All right, and then here you have. So we talked about credit reporting. So our consumer reports, the Fair Credit Reporting Act something that you definitely need to understand. It will be referred to on your exam, but it shouldn't be something that's hard to understand. It protects consumers against the circulation of inaccurate or obsolete information or financial information. In other words, it makes sure that any company that's publishing information on your financial situation or storing those records, that is accurate. So banks, credit reports, companies, insurance companies, things like that, when they're reporting credit, reporting things, they need to make sure that that stuff is accurate. Anytime you fill out a job application, an application for a credit card, for a home loan, for a car, or anything like that, you're going to sign a document that uh, that says you understand your rights under the Fair Credit Reporting Act as a consumer. You probably are familiar with that. HIPAA, Health Insurance Portability and Accountability Act. You do not have to memorize that. That is called that, right? But you do have to understand what HIPAA is. HIPAA is a privacy rule that protects the health information of patients. It also allows them to access their health records. Every time you go to the doctor or a dentist, you fill out some type of form that says that you understand your rights under the HIPAA law. Okay? And then lastly, here you have risks and rating classifications. So when a person applies for insurance, the insurance company is going to evaluate all that stuff we talked about. And then they're going to apply a risk classification. Those classifications are either preferred, standard, substandard, or decline. So preferred means great health, good income, strong MI Medical Information Bureau record, everything is good. Preferred status. Usually they get the lower payments, they get approved for the policy that they want. Standard, average risk, average age, average mortality rate, meaning they're expected to live the average time that a typical human is. So their premiums are going to be average policy. Substandard, high exposure to risk, usually are less likely to be approved, or they will be approved with a much higher premium. And then they're just straight up decline. All right. So those are risk classifications: preferred, standard, substandard, decline. Trying to go to the next slide. All right. We are almost done. We got about 10 more minutes and then we'll be wrapping up here. All right, so key documents. There are 2 key documents that are referred to multiple times throughout your training, throughout your learning, throughout your exams, and you will hear them many times as you're operating in this business. And they are a buyer's guide and a policy summary. The buyer's guide provides basic generic information about life insurance policies that contains and is limited to language approved by the Department of Insurance. This document explains how a buyer should go about choosing the amount and type of insurance to buy, and how a buyer can save money by comparing the cost of similar policies. Insurers must provide a buyer's guide to all prospective policy applicants prior to accepting their initial premium. All right. The world of insurance is a little complicated. There's so many options out there for people. All right. A buyer's guide, the Department of Insurance, right? We read right here. They want to make sure that everybody purchasing insurance understands what they're doing, what they're getting into, that they're making the best choice for themselves. They need to be giving a buyer's guide to help them ensure that they're making the best choice. Now, I want to give you a clue that I want you to write down or commit this to memory, because you're going to be asked at least one time, maybe twice on your exam about this specific thing, buyer's guide. And every time they refer to a buyer's guide on the exam that I've seen so far, they refer to it in relation to a universal life policy. So I want you to write down buyer's guide and write down universal. All right, and how I want you to remember that, I'm gonna give you this analogy. If you ever been to Universal, like the theme park, Universal, if you go to the theme park Universal in Florida, it's such a huge theme park, so many rides, so many attractions, restaurants, shops, different type of shows and different times of the shows and everything, that you need a guide, some type of guide that leads you around the park and allows you to help you make the best use of your time during your day at the park, because there's so much to do, right? So when you think about a buyer's guide, think about your experience at Universal. I need a guide to get me around the park. Buyer's guide, Universal. And you see it on the test, buyer's guide, Universal, buyer's guide, Universal. Commit that to memory. It will be asked of you. All right. But in general, any policy, it says insurers must provide a buyer's guide to all prospective policy applicants prior to accepting their initial premium. So in general, any policy, but on the exam, it's going to be referred to generally in relation to a universal policy. All right, policy summary. A policy summary is a written statement describing the features and elements of the policy being issued. It must include the name and address of the agent, the full name and home office or administrative office addresses of the insurer, and the generic name of the basic policy and each rider. A policy summary will also include premium, cash value, dividend, surrender value, and death benefit figures for specific policy years. The policy summary must be provided when the policy is delivered. So you want to know that the policy summary must be provided when the policy is delivered. You also want to know that the policy summary must have some specific things. These 3 things I want you to memorize. I know they had all of that stuff listed over here, all these different things, but the 3 things that they refer to mainly on the exam that the policy summary must have are the premium schedule, meaning when these premiums are due, and the death benefit, the amount of the benefit. Okay. All right. Lastly, a buyer's guide provides generic information on various types of policies. A policy summary provides specific information on the policy being issued. Okay, 2 different things. Buyer's guide is generic information on various policies. Policy summary, specific information on the exact policy being issued. All right, we're gonna go through this quick. We got 4 more minutes and I'm running out of time, so I'm gonna kind of speed through this, but we already touched on it. Look at the bottom right here. No premium, no coverage. When does coverage begin on an insurance policy? If there's no premium, there's no coverage. So coverage begins when a premium exists. That's basically what this is all telling you. At the time of the application, was a premium collected? Nope. A policy was issued. So guess what? At the time of delivery of the policy, the agent must collect the premium and a statement of good health, because at this point, they may have suffered some different health statuses than at the time of the application. So since they didn't pay at that time, the insurance company said, yeah, well, we're going to issue this policy as long as everything is good like it was when you first applied. So we need a statement of good health too with that premium. And then if that's the case, then coverage started on the day that premium was collected. In this case, the premium was received at the time of the application. Yes, it was. A policy was issued and coverage started the day that the premium was paid or the day the application was done, right? So basically, whenever the premium was paid, that's when coverage begins. If you remember that, you will answer 2 or 3 questions on the test. Whenever the premium is paid, that's when coverage begins. No money, no coverage. All right, adhesion. These are characteristics of a contract. Contract of adhesion, if you think of adhesion, if we go over, if you guys gotta go, let me know, but we may go over a few more minutes. We are almost done, down to the last 2 slides, okay? Contract of adhesion, think adhesive, like adhesive glue or tape, all right? One party prepares the contract, the other party must take it or leave it. It's just gonna stick, right? Adhesive, all right? When you get a mail order in the mail, they say, here, we're gonna offer you this. If you sign up and send this back in, you'll get this. That's a contract of adhesion. If you sign it, get back in, they're gonna give you exactly what they said. They're gonna give you nothing more, nothing less. Take it or leave it. Okay. All right, aleatory. Aleatory contracts are contracts that have unequal exchange amounts, all right, based on unforeseen circumstances. So for example, I get approved for a life insurance contract, for a life insurance policy, and I make one premium payment. So my insurance policy is for $1 million. I made one payment of $200, right? I die 2 days after I make that first payment. That insurance company got to pay out $1 million, even though I only paid them $200. That's aleatory. It's way imbalanced. Okay, think of a teeter-totter, aleatory. All right, conditional. Like it says, certain terms must be met. All right, it's based on a condition. So an insurance company might say, your insurance policy is approved based on a condition of you submitting to us a health assessment that says your health is in good status and this payment that we didn't collect when you first submitted the application, right? All right, unilateral, uni meaning one, right? Unilateral is a unilateral contract. Unilateral is only one party in the contract is legally bound to do anything. All insurance contracts are unilateral, meaning, oh shit. All right, can you guys hear me? Can someone let me know if they can hear me, because my phone died and now I'm back on my laptop. Okay, awesome. So you're not gonna be able to see my video anymore because my phone just died, but I'll talk my way through the rest of it. So unilateral is basically all insurance contracts are unilateral. Every insurance company is responsible for the legal side. So basically, if you're the insured, if you don't make a payment, your policy lapses, they just stop providing you coverage. But legally, nothing happens to you. You're just not covered with insurance. But if an insurance company doesn't make a benefit payout, then they're in trouble with the law. They're breaking the law. So they are held legally for what they tell you they're going to do. You are only held to making sure that you do it so that you maintain the benefit of that contract. But if you stop making payments, nothing legally is going to happen to you. But if the insurance company don't pay out that benefit, they can be in big legal trouble. Okay, unilateral. All right, and here's the final slide. So for some final notes, this is talking about how a premium is determined, how an insurance company determines what the premium dollar amount is, okay? We talked about risk calculation. They take a bunch of factors into play. Also included in those factors are mortality. Mortality is how long a person has to live, right? If you're 25, you have a longer mortality than somebody who's 65. Somebody who's 65 may have, on an average lifespan, 15 to 20 more years to live. Somebody 25 on an average lifespan has 40, 50, 60 more years to live. Okay, so the mortality rates affect the amount of a premium. If you were here, I think you might have you two in the room left may have missed it when we talked about earlier. A person who is 65 is a lot closer to death than a person who's 25. And as a result, if I'm applying for insurance at 65 and I'm a lot closer to death, then the insurance company is assuming more of a risk by insuring me at that age because their payout is going to come a lot sooner. And they know that than somebody who is looking for insurance at the age of 25. Although the person at the age of 25 might die in some unforeseen accident at the age of 26, but that's just how things go. But they look at the mortality rate. They also look at the interest, the level of interest. How much value are they expecting to replace? Okay, are they insuring your life and your house and your business? Are they just insuring enough for you to be able to provide disability payments, for in case you were involved in an accident or something like that? So interest, and then the expense. How much is it going to cost them to insure you? Understand this. The more premium payments you make every month, the more expensive your policy is going to be, because they got to do work every single month. If you make one premium payment a year, they're only dealing with you one time a year. If you make 12 premium payments a year, they're dealing with you 12 times a year. They're going to charge you a little bit more for that, especially if they're sending out documents and mailing things and communicating with you in other ways. So those are the three things that affect how they determine what the premium is. The mode of premium, this is going to be on your tests, is going to be referred to specifically as the mode of premium. So the mode of premium, to make it easy, is just the frequency of payments. Okay, how often the premium is paid. All right, the mode of premium is determined by how much the initial premium payment is, how often you want to continue making those payments in order to get to the goal. And the more frequently the premium is paid, the higher the premium. We talked about that over here. If I pay my annual insurance premium in one time, they may charge me $800. If I have to pay it every month, they might charge me $100 a month, which is $1,200 over the course of a year. So the more frequently premium is paid, the higher the premium. All right. And lastly, down here, USA Patriot Act. This will be on your test. They will ask you questions specifically about the USA Patriot Act. On September 11th, 2001, if you recall, Twin Towers were torn down in an act of terrorism. After that, they created the USA Patriot Act, which was designed to do this: fight and prevent terrorist activities. That will be asked of you on your exam, almost in that way. What was the purpose of the USA Patriot Act? Find and prevent terrorist activities, okay? Now, why is that important to insurance? Because terrorist activities also include laundering of money, using funds from legal sources to do illegal activities, all right? A lot of those funds sometimes are hidden in accounts such as insurance policies and things like that. So that's why it's important for us to know it as insurance agents, because we are obligated to help uphold the law to ensure that terrorist activities aren't occurring. So you need to know about the USA Patriot Act. You need to know, remember this date. You need to know that, at least be familiar with that date. Just think about September 11th, all right? October is the next month after September. So a month and a couple of weeks later, they came up with this act that said, we're not having this anymore. We're going to fight back against terrorism. Also, the USA Patriot Act enabled the FinCEN, F-I-N-C-E-N. It may be referred to on the exam as Financial Crime Enforcement Network, or it may be referred to as FinCEN, Financial Crime Enforcement Network. Requires banks, broker-dealers, and other financial institutions to establish an anti-money laundering standards. We already talked about money laundering. Money laundering, what that is taking clean money, taking dirty money, money that were received from doing illegal activities, and putting them into vehicles and mechanisms to try to get clean money out of them, like taking some dirty money, drug money or whatever, robbery, putting in an insurance policy, collecting on it later on. Now it looks like it was gathered through means of clean acquisition. All right. And you will be required as an agent to certify yourself understanding anti-money laundering laws. So it's important to understand AML, anti-money laundering. Remember those words. You will see those again on your exam. You will see FinCEN on your exam. You will see USA Patriot Act, fight and prevent terrorist activities on your exam. All right, we have reached that time of the session where it is nearly time to close, but I know that we still have a couple of people. We have Tasha, KD, and Maya. Thank you all for being here. I do want to ask you at this time, do you have any questions? Feel free, come off mute. You can ask me anything you want to ask, even if it doesn't pertain to what we just discussed, I'll be glad to answer it.
So actually, when it comes to, what's it called, aleatory, I believe?
Maya, it looks like you're, let me see, hang on one second. I'm sorry, I had my speaker off, so I didn't hear you, but I saw your mic moving. Can you repeat that again, Maya?
Yes, so when it comes to aleatory, when I mean, I think you mentioned like you just like say for instance, for example, if you pay like $200 and then you still get like, you know, like $1 million in return, then how does that work for like the insurance end of it? It seems like they'll lose a lot of money on that end, even though they do make a lot of money.
Yeah, so that is true. And it could be in that case. Typically, that's not the case. If you think about it from the perspective of like your own car insurance, right? You probably pay car insurance every month, and you probably have been paying car insurance for as long as you've driven a car, right? And if you were to get into an accident and totaled your car, the insurance company would typically pay for all the damages, and you'd probably be able to get a new car. But you could go your whole life and not get into an accident at all. And then die. I mean, I hate talking about mortality that way, and then die, never having taken advantage whatsoever of that car insurance policy, but you paid them $300 every single month, right? That's aleatory. You are, I don't want to call it the losing end, but you are on the opposite end of that aleatory exchange or that aleatory contract. They got the benefit of it because they collected all your money, but never had to make a single payout to you. So in that way, answering your question, most insurers never make claims against their policy. So the money that the insurance companies have is massive. So even if they do have to make an aleatory payout immediately on some policies, but that's a very rare occurrence. So they got billions and billions of dollars to make these payouts.
Oh, okay. Gotcha.
Does that answer your question?
Yes, thank you.
You're welcome. KD or Tasha, do you have any questions? All right, so we did go over a little longer than we anticipated today, so I will hold the knowledge check off for a future class, future session. But I do want to thank you all for being here today. I hope that you learned something and got something out of it. You have taken another huge step towards successfully passing your life producer state exam. We hope within the next 7 to 10 days, it's possible. I will tell you while you're here, just real quick, I passed mine in 2 days, and I'm not bragging, I'm not saying anything. I'm saying if I did it in 2 days, you could do it in 7 to 10. I did just, had to buckle down and grind it out. But ultimately, whether you're doing it in 7 to 10 days or by the middle of next month, We want to get you going, registered for your exam, taking your exam, passing that exam, and begin building your business. So don't let it linger too long. You know, the information, you're absorbing it right now. It's fresh on your mind right now. So the sooner you can take that information and apply it to an exam, the better off you're going to be. So don't let it linger. Go ahead and get registered as soon as possible so we can get you licensed. Okay. Tasha and Maya and Katie, thank you guys. And we'll have another session on Wednesday. Wednesday will be the same time, 6 p.m. to 7:30, and we'll be talking about the actual types of life insurance policies in more depth.
All right, thank you.
All right, you're welcome. You guys have a great night.
All right, you too. Bye.
Stop. Shoot. Let's call.